Tweezer bottoms are a crucial bullish reversal pattern observed at the lows of the market, signaling a potential shift from a downward trend to an upward trend. They are characterized by two consecutive candlesticks with nearly the same low point, regardless of their color, indicating strong support at a certain price level and suggesting that the market could be preparing to move upwards. The significance of tweezer bottoms in trading lies in their ability to provide traders with insights into market sentiment and potential reversal points. When identified correctly, this pattern can be a valuable tool for traders looking to enter or exit positions in anticipation of a market upturn. We encourage traders to practice identifying and interpreting tweezer bottoms in their trading activities. This involves closely monitoring price charts for the appearance of this pattern, particularly in downtrending markets where it can serve as a sign of an impending reversal. By becoming proficient in recognizing and understanding the implications of tweezer bottoms, traders can enhance their decision-making process and improve their trading strategies. It is also important to note the value of continuous learning and adaptability in the dynamic world of trading. The financial markets are constantly evolving, with new patterns and trading opportunities emerging frequently. Thus, an ongoing commitment to education and the willingness to adapt to changing market conditions are essential for long-term success in trading. Icon buttons. Candlestick patterns are critical tools in technical analysis, serving as visual representations of market movements within specific time frames. Each candlestick displays the opening, closing, high and low prices, revealing the sentiment and potential market direction shifts to analysts. Their significance lies in their ability to highlight trends and reversal points in the market, offering insights into future price movements. The piercing line is a prominent candlestick pattern recognized for its bullish implications. Typically emerging during a downtrend, it signals a potential reversal of market direction. The pattern consists of two candlesticks. The first is a long black candle, indicative of a continuation of the downtrend, followed by a long white candle. The key feature of the piercing line is the white candle opening lower than the previous black candle's low, but closing at least halfway up the black candle's body. This closure suggests a shift in sentiment, with buying pressure overcoming selling pressure, often leading to a trend reversal. Understanding the piercing line pattern helps investors identify opportunities to enter the market, anticipating a shift from a bearish to a bullish trend. Its appearance after a prolonged downturn can indicate the beginning of an upward momentum, making it a valuable tool for those looking to capitalize on changes in market direction. The piercing line is a candlestick pattern that serves as a bullish reversal indicator, commonly observed in downward trending markets. It is made up of two candlesticks. The first candlestick is a long black or red candle, representing a continuation of the current downtrend. The following day, the market opens at a new low, but then closes significantly into the body of the previous day's candle, typically covering at least half of the black or red candle's body. This second candle is long and white or green. This pattern suggests a shift in momentum from sellers to buyers. The scenario starts with strong selling pressure that keeps the price down. However, the next trading session opens even lower, which might initially suggest a continuation of the sell-off. Contrary to this expectation, throughout the trading day, buyers take control, pushing the price up significantly. This buying pressure is strong enough to close the day at a point that penetrates deeply into the losses of the previous day, hence the name piercing line. To illustrate the appearance of the piercing line in trading scenarios without using visuals, imagine you are looking at a chart where the price has been falling consistently. You'll see a sequence of predominantly red or black candlesticks reflecting this downtrend. Suddenly, a particularly long red or black candle appears, followed by a gap lower at the open on the next day, yet this day ends up closing well into the previous candle's body with a long white or green candlestick. It's as if the price action pierced through the gloom of the preceding days, offering a ray of hope for a reversal to the upside. This visual of piercing through the darkness is an apt metaphor for the optimism the piercing line pattern can signify in a dreary market. The piercing line is a bullish candlestick pattern that signals a potential reversal from a downtrend to an uptrend. This pattern is characterized by two main features: its shape and color, and its position within a downtrend. Firstly, the pattern consists of two candlesticks. The first is a long black candlestick, indicating a continuation of the downtrend with sellers in control. The following day, a long white candlestick appears. This white candlestick opens below the previous day's low, signaling initial continuation of the downtrend. However, it then reverses direction and closes above the midpoint of the black candlestick's body. This change represents a shift in control from sellers to buyers, suggesting a potential upward trend reversal. The colors of the candlesticks are essential for identifying the piercing line pattern. The first candlestick is black, indicating a bearish period, while the second is white, indicating bullish activity. The size of the white candlestick is also crucial. It must cover at least half of the black candlestick's body to confirm the pattern's validity. The importance of the pattern's position within a downtrend cannot be overstated for accurate interpretation. For the piercing line pattern to be considered a true signal of a reversal, it must occur after a clear downtrend. This context ensures that the pattern represents a significant shift in market sentiment rather than a minor fluctuation within a larger bullish trend. To illustrate, imagine analyzing a chart where the market has been experiencing a steady decline over several sessions. Suddenly, a day ends with a long black candlestick, followed by a session where the market opens lower but closes significantly higher, well within the body of the previous day's candlestick. This is a classic piercing line scenario, provided it takes place after a confirmed downtrend, signaling that buyers are gaining strength and a reversal might be underway. Unfortunately, I cannot provide real chart examples here, but understanding the key characteristics of the piercing line pattern and its significance in a downtrend can help investors recognize potential opportunities to enter the market just as the sentiment begins to shift in favor of an uptrend. The piercing line is a bullish pattern that indicates a potential reversal in market sentiment, suggesting that bulls may be gaining strength to overpower bears. This pattern emerges during a downtrend and is characterized by a long bearish candle followed by a long bullish candle. The bullish candle opens lower than the previous candle's low, but closes above the midpoint of the bearish candle's body. This setup suggests that the selling pressure at the beginning of the session was overcome by buying pressure by the end, pointing towards a shift in momentum. The psychology behind the piercing line centers on the change in trader sentiment from pessimism to optimism. Initially, the market experiences a period of strong selling reflected in the bearish candle. However, The following day sees a significant shift, with prices opening at new lows but quickly reversing as buyers step in confidently, pushing prices up to close well into the territory of the previous day's losses. This action signals to traders that the bears are losing control and the bulls are beginning to assert their strength. In essence, the piercing line suggests that the tides are turning. What was once a market dominated by sellers is now seeing renewed interest from buyers, indicating a possible change in direction. Traders may view this pattern as a sign to consider entering long positions in anticipation of an uptrend. However, as with all technical analysis tools, it is advisable to seek confirmation through additional indicators or patterns before making trading decisions. The change from bearish to bullish sentiment, as illustrated by the piercing line, showcases the dynamic nature of markets and highlights the importance of understanding market psychology in successful trading. The piercing line pattern is principally known as a bullish reversal signal that appears at the end of a downtrend. This pattern is identified by two candlesticks. The first candlestick continues the existing downtrend with a long black body, while the second candlestick opens lower than the first but closes within the upper half of the first candle's body. This closing action suggests a potential shift in market sentiment from bearish to bullish. This pattern is typically indicative of a potential reversal rather than a continuation of the existing trend. The rationale behind this interpretation is the significant buying pressure demonstrated during the period of the second candlestick, which indicates that buyers are starting to outweigh sellers, potentially leading to a turnaround in the market direction. To illustrate, consider a chart example where a significant downtrend is evident, marked by consistently lower lows. Upon encountering the piercing line pattern, one would notice an initial black candlestick reflecting continued selling pressure, followed by a white or green candlestick that opens at a new low but closes significantly higher, within the range of the preceding black candlestick. This scenario suggests buyers are regaining control and could signal the start of an upward trend reversal. However, the surrounding market context plays a crucial role in determining the reliability of the piercing line as a reversal indicator. Factors such as volume, the position of the pattern within a larger trend, and confirmation from subsequent candlesticks should be considered to enhance the accuracy of the prediction. For example, higher volume on the second day of the pattern can reinforce the likelihood of a reversal. Similarly, if the piercing line pattern appears after a protracted downtrend, its significance as a reversal signal is heightened. In summary, while the piercing line pattern is predominantly seen as indicative of a bullish reversal, it is essential to consider the overall context of the market to make more informed decisions. Chart examples demonstrating the pattern in different market conditions can underscore the importance of context in interpreting candlestick patterns and predicting market movements accurately. Understanding the piercing line pattern involves recognizing it as a bullish signal that suggests a potential reversal in the market trend. This pattern, found in candlestick charting, is characterized by a downward movement followed by a significant upward shift, which indicates a change in investor sentiment from bearish to bullish. To further validate the implications of a piercing line pattern, traders frequently look at additional indicators and market conditions. These include trading volume, nearby support levels, and the trend preceding the pattern. Firstly, trading volume plays a crucial role in confirming the strength of the piercing line pattern. An increase in trading volume on the day the pattern forms indicates strong buying interest and provides further evidence that the market may be shifting from a decline to an upward trend. Higher volume suggests that the bullish reversal is backed by a significant amount of investment, making the pattern more reliable. Secondly, nearby support levels can also provide context to the piercing line pattern. Support levels are prices at which significant buying interest is anticipated, preventing the price from falling further. If a piercing line pattern forms near a known support level, it adds credence to the notion that the market could be nearing a bottom and preparing for a reversal. The proximity to support levels suggests that the bullish sentiment reflected in the pattern has a strong foundation, potentially leading to a sustained upward movement. Lastly, the trend preceding the pattern is equally significant for its validation. A true piercing line pattern emerges during a downtrend, serving as a potential indicator of its end. The pattern's implication as a bullish reversal signal is more pronounced if it appears after a consistent period of bearish activity. This context is essential because it highlights a significant shift in market dynamics and investor sentiment. In summary, while the piercing line pattern itself suggests a bullish reversal, its significance is significantly reinforced or weakened by trading volume, nearby support levels, and the trend preceding the pattern. High trading volume, the presence of the pattern near support levels, and its formation after a downtrend collectively strengthen the validity of the piercing line as an indicator of a potential market reversal. The piercing line pattern is a bullish indicator found in candlestick charts used in technical analysis. It is recognized as a sign of potential reversal from a downward trend to an upward trend. This pattern appears over 2 days, with the first day showing a long red candle indicating a continued drop in price, and the second day opening at a new low but closing significantly into the body of the previous day's candle. The historical accuracy of the piercing line in forecasting market direction changes is noteworthy. It suggests optimism among traders as buying pressure overcomes selling pressure. However, like all technical indicators, the piercing line has its limitations. One key limitation is false signals. Not every piercing line leads to a sustained reversal. Market context and other influencing factors could overturn the pattern's bullish signal. Thus, it is crucial to use the piercing line in conjunction with other analytical tools. Looking at volume data, other candlestick patterns, trend analysis, and indicators like moving averages or momentum oscillators can help validate the significance of the pattern. Additionally, considering macroeconomic factors and market news that might impact price movements is essential. In summary, while the piercing line pattern can offer valuable insights into potential reversals in market trends, its reliability improves when used alongside a comprehensive set of analysis tools. This multifaceted approach helps to confirm the pattern's predictive power and manage the risk of misinterpreting market signals. Integrating the piercing line pattern with other technical analysis tools can significantly enhance the effectiveness of trading strategies. The piercing line is a bullish pattern suggesting a potential reversal is on the horizon. It's identified by a long red candle followed by a long green candle, where the green candle opens lower than the previous close but closes more than halfway up the body of the first candle. Here's how we can combine this pattern with other tools like the Relative Strength Index, RSI, Moving Average Convergence Divergence, MACD, and Fibonacci retracements for more robust trading decisions. First, combining the piercing line pattern with the RSI can provide insights into the market's momentum. When you notice a piercing line pattern, look at the RSI for a reading below 30, which indicates an oversold condition. This concurrence suggests that the market sentiment is shifting from bearish to bullish, presenting a potential buying opportunity. Second, integrating the piercing line pattern with the MACD can offer a confirmation signal for the change in market direction. The MACD consists of two moving averages that depict momentum. A bullish signal is strengthened when the piercing line pattern appears alongside a bullish MACD crossover, where the MACD line crosses above the signal line. This combination indicates rising bullish momentum, further supporting the decision to enter a trade. Third, using Fibonacci retracements alongside the piercing line can help identify potential support levels. Imagine the market has been on a downtrend and you observe a piercing line pattern. Applying Fibonacci retracements from the high and low of the trend can reveal key levels where the market might reverse. If the second candle of the piercing line closes near a Fibonacci retracement level, it reinforces the strength of the reversal signal. In real-world applications, consider a trader who spots a piercing line pattern after a prolonged downtrend. Before taking any action, the trader confirms the oversold condition with an RSI below 30 and notices a bullish crossover on the MACD. Anticipating a reversal, the trader then uses Fibonacci retracements and finds the close of the piercing line pattern aligns with a significant Fibonacci level, adding confidence to the decision to enter a long position. By employing this multi-faceted approach, traders blend the predictive power of the piercing line with the confirmation and precision of RSI, MACD, and Fibonacci retracements. This integration enriches the decision-making process, allowing traders to enter and exit positions with a higher degree of confidence. One common misconception traders have about the piercing line pattern is viewing it as a guaranteed signal for a market reversal without considering other prevailing market conditions. The piercing line indicates potential bullish reversal following a downtrend, but it should not be interpreted in isolation. To avoid this mistake, traders should look for additional confirmation signals, such as a subsequent rise in volumes on the days following the pattern formation. Another error is misidentifying the pattern due to a lack of attention to its specific requirements. For a valid piercing line pattern, the second day's open must be lower than the first day's close, and the second day's close should be more than halfway into the first day's candle, but not above it. Overlooking these details can lead to incorrect pattern recognition. Traders might also overlook the market context in which the piercing line appears. Its significance is heightened when it occurs at potential support levels or in oversold conditions, suggesting a stronger possibility of a bullish reversal. Ignoring the broader market situation can lead to missed opportunities or false signals. To improve pattern recognition and analytical skills, traders can 1. Practice identifying the piercing line pattern in historical data to gain familiarity with its appearance and variations in different market contexts. 2. Use technical indicators such as moving averages or the Relative Strength Index, RSI, as complementary tools to validate the potential reversal signaled by the piercing line pattern. 3. Stay informed about market conditions and events that could influence price movements, as technical patterns do not operate in a vacuum. 4. Engage in paper trading or simulation exercises to test how the piercing line pattern performs under various market conditions without financial risk. By mastering these strategies, traders can enhance their ability to correctly interpret the piercing line pattern, integrate it effectively into their trading strategy, and make more informed investment decisions. To effectively leverage the piercing line pattern in trading, traders should focus on identifying this pattern at the end of a downtrend. The piercing line is a bullish reversal pattern that offers clues for potential entry and exit points. When this pattern emerges, it suggests that buying interest is starting to outweigh selling pressure, potentially signaling a shift in market sentiment. For setting entry points, traders often wait for additional confirmation following the appearance of the piercing line pattern. This might involve waiting for the next candlestick to close higher than the closing of the piercing line, or looking for other confirmatory indicators such as moving averages or volume increase. Exit points, on the other hand, are typically set by identifying potential resistance levels or by setting a target return. Some traders also implement trailing stop-loss orders to protect gains as the price moves favorably, allowing them to remain in the trade as long as the trend continues. There are stories of traders who have effectively utilized the piercing line in their strategies. One such trader noticed the piercing line pattern forming at a key support level after a prolonged downtrend. Recognizing the potential for a reversal, the trader entered a long position the following day after observing an increase in volume and a strong bullish candle, confirming the reversal signal. By setting a calculated exit point just below the next resistance level and using a trailing stop loss, the trader managed to capture a significant upward move, maximizing gains while minimizing risk. These strategies underscore the importance of patience, confirmation, and risk management when leveraging candlestick patterns like the piercing line. Each trade requires a unique approach informed by the trader's broader analysis and market conditions to identify the optimal entry and exit points. The piercing line pattern is a bullish signal in technical analysis that suggests a potential reversal of a downtrend. It consists of two candlesticks on a chart where the first is a long black candle found within a downtrend, followed by a white candle that opens lower than the previous close but closes at least halfway into the black candle's body. This indicates that buyers are starting to outweigh sellers, potentially leading to a shift in market sentiment from bearish to bullish. However, beyond the piercing line, there are variations and similar patterns, each with its unique implications for trading. One important variation is the bullish engulfing pattern. Unlike the piercing line, which requires the second candle to close within the body of the first, the bullish engulfing pattern shows the second candle completely engulfing the body of the first candle. This signifies a stronger bullish reversal because the buying pressure was enough not only to recover from the previous session's losses, but also to push prices beyond the starting point of the first candle. Another relevant pattern is the hammer, which appears at the bottom of a downtrend but consists of only one candle. The hammer has a small body at the top of its range and a long lower wick, representing a significant sell-off during the session that was followed by a powerful rally closing near the high. It indicates that despite the selling pressure, buyers were able to take control by the session's end, hinting at a potential upward reversal. The dark cloud cover pattern serves as a counterpart to the piercing line, signaling a potential bearish reversal. It occurs during an uptrend and involves a long white candle followed by a black candle that opens higher than the previous close but closes well within the body of the preceding white candle. This shows that sellers are beginning to dominate what was previously a bullish market. While conceptual understanding of these patterns is crucial, visual interpretation through chart examples is indispensable. For instance, in a piercing line pattern, analysts look for a significant downtick represented by a large black candle followed by a swift recovery indicated by a white candle that closes within the top half of the black candle's body. With a bullish engulfing pattern, the focus would be on identifying a smaller black candle completely covered by a subsequent larger white candle, signaling a strong buying momentum. In contrast, a hammer pattern would be identified by a single candle with a small body and a long lower wick, indicating a session where buyers managed to counteract sellers by the close. Understanding these variations and their interpretations can significantly enhance trading strategies by providing insights into market sentiment shifts. However, it is also important to incorporate these patterns into a broader trading plan that includes analysis of market context, volume, and other technical indicators to make more informed decisions.